Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Anderson. Tom is the president and CEO of Pensco Trust, which is an IRS-approved non-bank custodian for self-directed retirement accounts. Tom grew up in New York and in 1969 started working at Hartford National Bank, where he became the head of systems development and strategic planning. Then in 1981 he came to Bank of America in California, where he became the head of trust systems development and trust and stock transfer data processing. Then in 1989 he co-founded Pensco Trust. He has testified for the Department of Labor and the IRS about IRAs, instigating changes in the IRS regulations governing IRAs, specifically relating to the capital requirements for any company offering IRA services. He was invited to Washington, D.C. in March 2009 to participate in an elite group called the Future Finance Initiative to make recommendations about the future of banking in the United States. Today, Tom and I are going to be talking about investing in real estate in your IRA or Roth account. Now, before we get started, I want to caution you that we're discussing areas of issues in a very complex area. And so this is a starting point for a bigger discussion that you should be having with your tax advisor or other advisors. And we want you to get qualified legal and tax advice. So with that, Tom, welcome.
Well, thank you. It's a pleasure to be here in the not-so-sunny San Jose today. It's a little downpour out there, but certainly a pleasure. I just want to clarify one point, Mike.
Okay.
We started out as a non-bank
Okay.
custodian approved by the IRS back in '89, but we later became a broker-dealer, and then we now are a bank and trust, so we're a fully regulated financial institution.
Okay, so people might be interested to know that as far as the status of Pensco, and we were talking about this actually before we got started, that he does have, for example, bank auditors actually come to look over their operations and so forth. So for their customers, that's an additional layer of security that they may not have with some other custodians. Okay, well, with that, Tom, why don't we go ahead and get started with some of the questions?
Certainly.
So, first of all, why did you get into the area of offering independent trust services for IRAs?
Well, as the expression goes, necessity is often the father of invention, and I was laid off at Bank of America when they sold their trust department to Wells Fargo. So I went out and bought myself a brand new Macintosh, the first one that they came out with, and started building a consulting business with it, and that led to an assignment working for somebody that does what we now do, that needed a lot of help, and I realized that my background in trusts and investment systems was perfectly suited to establish and run a custodial firm.
Great. Okay. So why would someone consider the alternative of a self-directed IRA with an independent trustee instead of like a brokerage company or going to their bank?
Well, first of all the companies that I compete with, we're all the same basically as to how we operate. We don't either sell investments nor do we give investment advice. So the law is quite broad in terms of what you can invest in.
Mm-hmm.
So anything other than life insurance on your own life, which makes sense because you cash in when you cash out, and that doesn't help you in retirement, or collectibles, or the stock of Subchapter S is something you can buy with your IRA. The brokerage industry focuses on stocks, bonds, and mutual funds, more what they call traditional assets.
Right.
And they won't generally allow you to do a real estate transaction or even private equity unless you have an awfully large account. And the banks typically offer a family of mutual funds and CDs, and they don't generally venture into this area as well. It's more complicated and there's a lot more paperwork involved.
Right. So I guess what it comes down to is getting more choices outside of what people think of as conventional investments, and we'll get more into depth into that as we get through these discussions. So again, how is your service different from a self-directed plan? Because a lot of banks and particularly brokerage companies, say, we have a self-directed IRA
Sure.
that we offer to you.
Well, self-directed is a functional term. It's not a legal term. Essentially, it's a way of describing the fact that the IRA owner is the one that makes the investment decision, not the broker, not the investment advisor, not the custodial firm. So all of the firms that say they're self-directed, are self-directed in a sense, and that is that you have to tell them what stock to pick or to buy for you, or what bond or what mutual fund. But they do put you in that silo of the traded asset silo, so that what we saw happen in this last downturn, brought us back to a level where people lost about 40% of their retirement assets because they were locked into that space, either through a traditional 401k or other defined contribution plan, or with their brokerage account, their IRA brokerage account. In our case, many of our clients actually did quite well during that 2000 to 2008 time frame, until it really dropped in September 2008, because they were riding the wave of real estate, which was going gangbusters. You didn't see the dot-com era happen in real estate. It was really booming. Now, of course, they needed to exit at the right time in the market, because every market has its cycle, but many of our clients did quite well.
Good, okay. Yeah, so what it boils down to is, what are the choices? And when you're dealing with a company like yours, there's really much more flexibility that you can get. And of course, there's a price to be paid for that. So anyway, what types of retirement plans does your company handle?
Well, we handle every type of IRA account, and that includes Roth IRAs, SEP IRAs. We also handle what is called a solo K, which is a 401k for either a single proprietor or a man and wife working in the same business. Once you introduce full-time employees beyond the two, the man and wife, you now become subject to ERISA, which essentially forces you back into an array of traditional investments. And that's an unfortunate thing, because again, people are not allowed to diversify outside of the stock market, and they are therefore exposed to systemic risk when the whole market goes down.
Right. So related to this, maybe a little side issue, is there are quite a few employees that after they leave their money in their 401k. And that means that now they are left with the choices that are offered through that 401k, through their employer or whatever. And so they don't have the flexibility, again, of getting into some of the alternative investments that we're going to be talking about. Specifically, and today we're focusing on real estate related investments. And so anyway, so if they're interested in getting, if you will, more diversification, that I think that's sort of the goal here, then they need to do a rollover.
Sure. You have three opportunities when you change jobs, whether it's due to retirement or just taking another company's job. And the first is to roll it over to an IRA, which and if you go to a self-directed custodian like us, then the sky's the limit as to what you can invest in, as long as it's within the law. The second possibility is to roll it into another 401k of your future employer, provided their plan allows that, when in most cases they do. And the third is to take a taxable distribution, which you don't want to do, because they're going to withhold 20% for future taxes right off the bat. So if you were taking $100,000 out, they'll give you a check for $80,000 and withhold $20,000.
Right.
So that's not the best approach. You always want to keep your tax-deferred and tax-free portfolios aside, and the last ones you want to tap, because you get that free compounding
Right.
or deferred compounding.
Right.